markets are suffering severe withdrawal symptoms. Let's talk about it. Hello everybody, Joe Warby coming at you. And if you watched my video last week, you're probably thinking, what in the heck was this guy saying? Because when I recorded it, the market seemed to like the 0.5% increase that Powell announced last week. But man, oh man, the next day that all changed. And as you can see, since Fed Chairman Powell announced a simple 0.5% increase in rates, the stock market has done nothing but lose. We can see here the Nasdaq's down over 7%, the S&P's down about 4%, and the Dow's down about 3% since he made that announcement. Now, let's put this into perspective. Since 2008, interest rates have been near zero. That means that money has basically been free. And the economy, the stock market, businesses have become addicted to free money. And whenever you have an addiction, if that drug is taken away, you go through withdrawals. And that is what the stock market is doing right now. They are going through massive withdrawals because that free money seems to be disappearing. And really, it's not, because all the Fed is trying to do is try to tamper inflation, which, as we can see in April, inflation barely rose from March, and that's a good sign that inflation is beginning to taper off. We're not going to see another 8 or 9% increase in inflation. Inflation is coming to a point where it should begin to drop. But the markets have been used to low interest rates. They've been used to free money, and Fed Chairman Powell is beginning to increase interest rates. Now, he only wants to get to between 2 and 3%. Now, let's look at history. History tells us that when the Fed increases interest rates in an already high interest rate environment, that's bad for stocks. However, when the Fed increases interest rates in a very low interest rate environment, that's positive for stocks. And since 2008, the last time we saw the Fed increase interest rates was between 2016 and 2018. And what did the stock market do? Well, as I just said, the stock market likes an increase in interest rates when interest rates are low. And we can see between 2016 and 2018 that the Nasdaq, the S&P, and the Dow all gained between 34 and 55%. That is a huge increase during a time when interest rates were going up. So what we're seeing here is we're seeing the markets overreact as they always do. Now, they are looking and hearing that the Fed may do another 0.5%, another 0.5%, another 0.5%, but it's what we have to do to get back to normal rates. Now, the positives, as I've been saying over and over again, there are a lot of positives. Corporate profits had their best year increase last year. We saw corporate profits up over 37% year over year when you factor in tax savings. That is the largest increase in corporate profits ever recorded since they began recording corporate profits. So that means corporations have more money than ever. As I've said, there's over $5 trillion just sitting in cash. That is a large amount of cash to handle whatever may come down the road. And unemployment is at a 20-year low. I mean, 3.6%. That means pretty much everybody who wants to work is working. We've hit full employment. We've hit a time where people are making more money, and the markets are overreacting. This happens. This is not going to last forever. Could it continue to fall? Of course it could. Could we see the markets continue to go down for a few more weeks? Of course we could. At the beginning of the year, I predicted in the Dow about a 13 to 14% correction, which is typically what you see when you see 2 years of growth like we saw in 20 and 21. This is normal. This is expected. I am not surprised by this. Well, I guess I am a little surprised that it is falling to the level it's falling and that the market is overreacting to this news. I mean, this is what we have to do to get back to where we need to be to have a strong economy. Imagine putting your money into a savings account and actually earning interest. Imagine opening up a money market account and getting 3, 4, 5% interest rate on a risk-free investment. That is what we should be seeing when the Fed is finished. So, are markets down? Yes. The question you have to ask yourself, is now the time to sell when markets are down? It's probably not a great time to get out of the markets when they're down. Could they go down further? Yes, they could. But do you need the money? Is this money that you need to spend right now? If the answer is no, I don't need the money, then you may not want to get out when markets are down, because what emotions tend to make you do is sell when markets are low and buy when markets are high. And that's not what you're supposed to do. You're supposed to buy when markets are low and sell when markets are high. So just take a deep breath. Look at the numbers. The last time the Fed raised rates, a 30 to 55% increase in market value. That is normal. I'm not saying we're going to see that again because we had such great years in 20 and 21, but we should not end up negative this year. But hey, who knows? Markets could overreact and they could just be silly and they could just say, we don't like inflation and we're just going to be negative for the year. I don't think that's what's going to happen. Let's see what happens when the markets are done coming off the withdrawal symptoms of free money, get back to where we need to be with 2 to 3% interest rates from the Fed. I think we'll see a much stronger overall economy. If you like videos like this, make sure you subscribe. Check back every week for new videos. Leave a comment down below. I love reading your comments, and I'll see you next week.